A very good evening, everyone, and thank you for joining us today for this exclusive webinar on US Fed rate reset. So, finally, the US Fed has finally pivoted. After 8 months of holding steady, the FOMC has cut the policy rate by 25 basis points to 4.25%. It's the first step in what could be a gradual easing cycle, probably. So now the markets are asking, is this a risk mitigating cut or the start of a longer rate cutting cycle? And more importantly for us, what does this mean for the fixed income investors? I'll take a minute to set the backdrop for our discussion for the evening. The unemployment rate has ticked up in the US, and the Fed now sees downside risks to employment as significant. Inflation is still sticky, and tariffs further could add some upward pressure on the prices. Now, talking about the growth, the Feds project a little softer demand conditions for growth going forward. And on the housing side, the construction activity has fell sharply also in the month of August 2025. As Chair Powell reminded us on the same that one cut or one small rate cut won't fix the structural housing shortage that persists in the United States. This backdrop explains why the US Fed delivered a very cautious 25 basis points rate cut move, a balancing act probably between guarding against the labor market weakness and all the while staying vigilant on inflation. So to talk more on the same and to deep dive on the same and of course its effect on the Indian fixed income markets, today we have with us fixed income analyst and fund manager Ms. Kruti Chheta. Welcome, Kruti.
Thank you, Tanya. Thank you, everyone, for joining us this evening.
Right. So for the understanding of our viewers, this will be a Q&A sort of a session, wherein I'll be asking Kruti certain questions and she'll be, answering on that. And for our viewers, we'll be taking your questions towards the end of this webinar. So without further ado, let's start. So, right. Just a second. Yeah, so I'll briefly take everyone through, what all we'll be discussing on today. So first and foremost, the US Fed's decision and, the macroeconomic landscape of the US that's prevalent at this point in time. The global spillover, could it be there or could not it be there? And, emerging markets in this backdrop. Then coming on towards the India versus USA policy outlook, how same or different are they? Then implications for the Indian investors and at the end investment case or the products that fixed income investors could look at this juncture. So Kruti, my first and foremost question to you is that the US Fed has finally cut rates after holding it for almost the entire of 2025. And now could you briefly explain what are factors that are the same which pushed Fed to cut the rates at this juncture?
So Tanya, if you see throughout the beginning of the year, there has been uncertainty, or the word has been uncertainty. And we have seen that playing out for a very long time, that there is going to be uncertainty that how much inflation is going to go higher, or other factors, whether the growth is going to get impacted or not. Now, what we have seen in the numbers is that the employment has seen a big drop, which was revised downwardly, and the average of last 3 months, the job openings has come down to 29,000 jobs each month, which used to run pretty much higher on 50,000 plus every month, showing that the strength in the economy continues. So in a situation previously, before this policy, the situation was that your inflation can go up and it is already above your target band of like 2%. Your growth rate is somewhere around 1.5%, which is an good growth rate for such a large economy, and your employment was going good. Now, out of these three factors, all three were doing well at that point of time, inflation being on the negative side and growth and unemployment being on the positive side. Now, if you go to see the Fed's focus, has now shifted from inflation growth to now unemployment because of the numbers revised down largely. The fear is that if the unemployment rises from here, which is already given in the number that it could reach 4.5%, and the job openings are reducing, in spite of the fact that the immigration laws have become much more stringent and there is less of the immigration happening, in spite of that, the unemployment number rising, is putting the economy into a circle where, because of the unemployment, the growth might get compromised, and inflation might still stay higher, not because the demand in the economy is there, but because the supply side is getting disrupted. So that could be a classic situation which would be very difficult for that. So Fed is just addressing the number which has been shown to them, that the employment is getting affected. And in addition, if you see the other high frequency data which is there, so if you see, for example, your housing prices are crashing now in spite of the rates coming down. It is the people are not buying houses anymore. You are seeing that your consumer confidence also keeps wavering a lot. Last month, again, the retail sales number was good. But again, if you see, there is a lot of volatility in the expectations also. If you see the inflation expectation also, it went right up, then it came down, and now again the inflation expectations are building on for a higher number on the ground level. So it is trying to address the problem which has been given rather than forecasting or playing on the forecasted number. That's why on employment and other high frequency data which is showing that there is unease amongst the consumer, they have played out on that on the interest rate. You're on mute, Tanya.
Right. Sorry for that. So now that Kruti have given us, the backdrop for this decision making, even, when the Fed chair comes, he also comes up with a summary of economic projections, wherein, they tell the entire market and viewers that, what the Fed sees in terms of inflation, in terms of unemployment rate, in terms of GDP for the US market, say in the short term, in this calendar year, in the next calendar year 2026, and over a longer term basis. So how would you describe, the current and the projected US macro landscape, especially, when we talk about the numbers like numbers on factors like jobs, growth, inflation, and has it become a little more complicated than usual with, what is playing out in the US markets, say in terms of tariffs and currency?
So here the word that Fed chair used during his narration was the projections are probabilities and they are outcome of the data that will be coming out. There is no certainty that this would be followed, and this is something that has been the buzz around the market, that the projections come something else, and there are a lot of charts which have been circulated at the beginning of the year. The projections were so on, and end of the year, the projections vary. So, which is why we've seen that he has very carefully played that the projections are probabilities, not in real terms exactly how things are going to pan out. And as we see in the numbers also, this is yet another projection which you're seeing that GDP growth has been revised 20 basis upward for 2025 and 26. Now, in a typical economic scenario, how it plays out is that if your unemployment goes higher, which they are fearing that the unemployment will go higher, then probably 2026, we are not seeing a number of 4.4, we are seeing a number of 4.5, or we are seeing a number higher. And if your unemployment is going higher, then would the real GDP go higher because the spending might not be there on the in economic side? So would a 20 basis uptick in the GDP justified? As of now, there is no clarity, and he mentioned in his press conference also that I have not found even a one forecaster who is ready to say that this is how exactly it will pan out. So there is no economist who's predicting the how things are going to pan out. Neither does Fed have the view on how it is going to pan out exactly. And as market, you and me also are as uncertain as they are. But what we can see is that there is a lot of variance in the opinion as of now amongst the Fed members, and this is the most divergent chart that we would have seen in terms of where the rates are expected to be. With one expecting that there will be a rate hike, also one expecting that there is going to be 100 basis rate cut from here on. And the most divergent is that there is six members which are saying that this is going to be the last rate cut for this year, whereas there are nine members which are saying that there are going to be two rate cuts. So it's a very confusing dot plot, and the confusion within the dot plot itself says that there is a lot of opinions within Fed members as of now. It is very complicated because typically how again things happen is that unemployment increases, your growth goes down, and because your growth goes down, your inflation goes down. But here we are looking at a situation where your unemployment is increasing, growth might or might not go down because corporates might, do better because of the investments coming in, the entire AI boom. But we might see that inflation might also see an uptick. So all three of these factors, which in a typical economy are linked to each other, are not getting linked in the similar fashion in this situation.
Right. So this relationship between all the factors, which is supposed to be either direct or indirect, it's not making sense right now. So then can one say that, it's stagflation on the cards for the US economy in the coming future?
Slowly the situation is building up. This has not happened. The last time the situation happened was somewhere around in 1970s, where the oil prices are risen and your demand was not getting created as much, but your prices of the goods were going up as much. In this situation, what we are seeing is that the inflation has not skyrocketed as yet. Could be because the corporates are absorbing it, could be because the exporters are not passing it on as of now, or the entire impact of the tariff has not come in. It could be a slow progress towards it, because stagflation is typically a situation where your inflation is high, but your unemployment is lower, and sorry, your unemployment is higher and your growth is lower. We are facing at such a situation, but it is not a drastic uptick towards that situation. It's a gradual movement towards that situation. And things could change if the policies loosen up around tariffs, or there could be new developments, and we see that inflation might not tick up as much, and the loss that has been made so far gets covered up in the upcoming policies.
Sure. So probably, if factors remain this way even in the near future, then we might look at a stagflationary sort of an environment, right? So moving on, you also talked about, the divergence in the dot plot that, how it was one member who also voted on the extreme right side of it. Probably one can say that, they wanted a higher quantum of rate cut. So how this split is viewed, split between the FOMC members is viewed in the backdrop of, say, bond markets. And what does this tells about the volatility that we are a little bit looking at, the bond market, specifically talking about the US bond market?
So the split definitely says the state of the mind of the US economy in itself, because it's a 19-member committee and they are on the top of the game with all the information that could possibly one individual have about the economy. And that is how the entire economy is thinking as of now. That split, will it translate into the volatility into the bond market? So if you see, volatility in the US is more on the longer end rather than on the shorter end of the curve. The shorter end is still taking the impact of the rate cuts or the possible rate cuts, and we've seen that the yield curve has steepened over the period of time, uh, taking in the rate cuts into account. But your longer end is not reacting to that. In a typical situation, when there is a rate onset of the rate cut cycle, first your longer end of the curve will react, and then your shorter end of the curve will react to the actual rate cut that happens. But in this situation, it has not happened. The longer end has not reacted, whereas your shorter end is reacting. And mind it that right now, since last 2 years, because there are fiscal constraints for US economy, US has been issuing the treasuries into the short end of the curve rather than the long end of the curve. So it is not that the long end of the curve has a lot of supply also. It's not a supply heavy section. In spite of that, we are seeing that the shorter end of the curve is going down and longer end is not going down, is because there is an uncertainty that the markets are depicting with the US, whether it is the government policies or whether it is the freedom of the institution as a Fed as a whole. There is an uncertainty which is there. The confidence is not there into the longer end of the curve, and that is what we are seeing. The volatility will continue till the uncertainty will continue, and the questions will be raised on the independence of the committee.
Right. So, while we have now talked about a little bit more on the US side, now, little bit by going towards the emerging market side. So historically, the Fed decision is known to have a ripple effect globally. Now, how do you see this particular rate cut impacting the rest of the world, especially global capital flows or FIF flows, which are called into countries like India or even other emerging markets, if you would like to take up that.
So, yes, in the days before all this took place, Fed used to be the big daddy, and the decision which the Fed takes, there was a ripple effect, and it was passed on to the other central banks very easily. But increasingly, what we have seen is that there is a divergence between the Fed and the other central banks. And this is not only the product of 2025, we have seen that before also. The reason being that the dynamics of the economies are changing very fast. To simply compare, there is a lot of divergence between emerging market and developed markets. In today's situation, if you see, developed markets are facing a lot of backlash because of the fiscal deficit, the deep fiscal deficits that they have. They want to go on the expenditure spree, but they're already debt heavy and there are less takers of those bonds. Their inflation target is at 2%, but most of the economies are not close to 2%. They're all, about 2%. US is at 2.9%. Other economies are also well above 2%. And the spending towards which they are aiming at could be more of the social welfare, which are not very revenue generating for most of the developed economies also. So there are a lot of constraints which are coming in for the developed economies, and it's not that what they were doing is being followed by emerging economies. Vis-a-vis, if you see emerging economies, the sovereign debts are much lower. Most of them are between 70 to 80% of their GDP, compared to what developed markets are 100% plus. They are well within the fiscal limits. For example, India fiscal deficit is near 4%, but if you see 4.4%, but if you see for US, for such an economy, it is shy of like 7% now, and other economies are also that much high. If you see inflation, for this entire 2025, we have not reached our lower band of 4% also. We have stayed well below 4%. If you see for China also, China is in deflation, it's not in inflation, and China is supplier of the to the world. So it is going to export their inflation also to the other economies, in all fairness. So the dynamics between the developed markets and developing markets are very different as of now. Emerging markets look much more attractive than developed markets in terms of the debt. Yes, but the challenge with few emerging markets is that even though their macros are strong, there has to be a stability within the economies. If the stability is moved, then there is an issue. So the investors will also be looking at that which economies are very stable in the emerging markets, and they will go and invest over there. India, for example, is seeing FII flows now because we have macro stability, and we have, the political stability also as of now in the country. So these are going to be, now we are going to go into the micros also of each economy, that within the emerging economies also, which are looking good. And gone are those days where, the effect will be same of the developed markets and emerging markets.
Right, so probably fiscal prudence, one can say, is what separates emerging and developed markets at this point in time, and hence one can see, the FI flows, particularly in the fixed income side, coming in India. Right. So now moving towards India, like you mentioned, how is India's macro backdrop, like say, for example, if I have to talk about factors like GDP growth, inflation, and fiscal position, different from the US right now?
So, like we discussed before, compared to US, we are like ticking all the box, right, and we are actually outshining in all the areas. Inflation below 4%, our upper band is 6%, lower band is 4%, and we have hovered around 3.5%. Last two inflation readings coming close to 2% or less than 2%. Fiscal prudence, we have only shown a consolidation path, without even blinking towards, going above the fiscal deficit. If anything, last year we actually came below the targeted ones rather than going on the expansion. uh, Other factors like CAD, we are very comfortable now because of two reasons. One, that the oil prices have not moved much, the commodity prices have not moved much. And second is that over period of time, the dependence of our our inflation basket on the oil has also reduced because there are introduction of the new and renewable energies into the systems that have taken over. So the fluctuation in the commodity prices, such as oil, also now impact us less than it used to impact us a decade back, and that is true for most of the economies today. And fourth, GDP growth. Yes, we are the fastest growing economy, but we are not at the growth pace which we had decided to be on. So the ideal GDP growth rate, nominal GDP growth rate for us would have been somewhere about 12%, but we are somewhere around below 10%, hovering around 9% as of now. But it is not only us that has slowed down on the growth, the global growth has gone down, and within that, we are outpacing. Yes, there are efforts by the administration to boost that growth as much as it can. But if you see on the stability point of view, we are ticking all the right boxes compared to what the other economies are doing. And on that backdrop, we are much more stable compared to any other economy.
Sure. So now that India, looks like ticking all the right boxes, like you just mentioned, be the fiscal prudence, be not being, to on the inflation part, not being even towards the lower band of 4%, but being under the 4% band, on the inflation side, which is within the range. And then, probably a little dim, but still positive note, GDP growth. With all of this into play, how does the India's interest rate stance diverge from the US, particularly the Feds, and why does it do so? We have seen, the RBI has been more cautious in terms of rate moves until now. It has given a front-loaded 100 basis points before in the year. So how do you see the divergence? And then my follow-up question is that, the elephant in the room question probably is what will RBI be doing on the 1st of October 2025? But I'll not put you on that spot. But in your understanding, why the divergence and what are the probably routes for RBI, in the upcoming MPC?
The divergence has already happened, and not only for India, for most of the economies, the divergence has already happened because most of the central banks has already gone on to rate cuts, and probably they are on pause. And Fed has just started cutting on the rate. So it is not only India; most of the economies have gone into it. India has been preemptive towards it because it was about time that we become more domestically focused than globally reliant on what the policies could be, and that is what we have done. We have been preemptive, we've been more inward looking, that if our factors are stable, then we need to take an action, and what is right for us has to be delivered, because now we are targeting ourselves to becoming the third largest economy. We have a target of 2027 which is ahead of us. So we've become more confident in our dynamics, and which is why we've been more preemptive in taking the rate actions. For the upcoming policy, does anything depend on Fed? Why the window that we had or what we could utilize, we have done so far by the front loading of the 100 basis point. Does the Fed rate cut change anything? Yes, it does change a few things because a Fed rate cut would again open up a window for MPC to cut further rate cuts. See, so far domestically, what we could have driven, we have done it so far. But when the global rates also move, then there is a possibility that the domestic rates could also move, and it is an indication that okay, global is looking at a more slowdown. Then that could have a ripple effect on the domestic economy also, and we need to do a little more, push ourselves a little more for a rate cut. So a Fed rate cut of a 25 or a 50 basis from here on, which is saying as per a dot plot, opens up a window for us also for a 25 to 50 basis rate cut. We have done 100. Now, how soon that happens depends on how much we want to front run more, or we want to see the impact of the previous rate cut, or we want to see the impact of the policies that have been taken place, or you want to aid it as of now. So we have seen the GST 2 coming in place, and we are seeing that that is a push towards the demand that is there. Now, either we can wait and see a quarter that has this played out because we are on the edge of the festive season and there have been measures taken so that the transmission of the GST happens faster. So one is that we sit back, we see that, is this already, is it transmitting already the rate cuts and the GST? Or there can be again a preemptive action where we see that, okay, GST is done, the window is opened up, and we go for a 25 basis more. There is a scope for 25 to 50 basis based on how the Fed reacts, but timing is something that RBI will decide on the mood and how preemptive or do they want to wait it out.
Sure. So probably transmission of rate cuts would further, aid RBI in deciding where it should be on the stance side. Sure. So Kruti, now coming to the million-dollar question that, we have heard on the what US Fed did was the economy of US looks like, how India is better positioned among the emerging markets. The main question that everyone has, every viewer or investor has is, what is the investment case as of this point in time in the fixed income space? So yeah, that's my question to you. What could one look at, to go for or to invest into at this juncture?
Fixed income, India, as per the macro dynamics, it is a beautiful story and it's a no-brainer. But what we are getting impacted as of now is by the global developments, the uncertainty around that, especially the volatility with the tariffs that we are seeing, and that is impacting the currency, which in turn is impacting the flows into the market, especially the equity market. We've seen that the flows are coming back into the debt market, but equity markets, it's still not stabilized, and the confidence has not come because of the tariff that is imposed. So because there is some pressure on the currency because of this, right now it is better to be on the neutral or the shorter end of the curve. But as the developments are happening and the case is building up that we will eventually have a tariff deal with US and we will work with them, the window opens up for the longer tenure also. But this is tactical to how fast we have a deal with US and how the things turn positive for our domestic markets, in not only in terms of like tariff, but also in terms of the flows. So if that turns around and we have a deal and we have the stability of the flows, then it will definitely stabilize the currency more, and we will see that along with the rate cut, the stability in the currency will open up the window for the longer duration also. So for near term, you can stay on the shorter end of the curve because even if there is no immediate rate cut, the expectation of the rate cut will play out in the shorter end. There will be steepening of the curve. But tactically, if you want to play in the debt, then you can look at a fund like income plus arbitrage, which will change the position when there is an opportunity in the longer duration. So you don't have to worry about it, and the fund itself will switch from the shorter tenure to the longer tenure uh, as and when the opportunity opens up.
Sure. So probably what you're suggesting is that, funds on the shorter end of the yield curve, 3 months to 3 years funds, which are say categories like ultra short duration fund category, money market fund category, low duration fund category, short duration fund, and along with it, a very dynamic active FOF category, which is also very much tax efficient in itself, which is income plus arbitrage would make sense at this juncture.
Right.
So, thank you for this, Kruti. And now, viewers, we are open to your questions. So, yeah, put on your questions on the Q&A box. So, Kruti, while the questions come, I just have one question to you. That if rate cut probably is not something that RBI could look at, what are other monetary policy tools that RBI could look at, given we'll be around festive season, there'll be liquidity crunch, probability of a liquidity crunch in the market also. So what all monetary policy tools could RBI, look at this point in time?
So if it is not an immediate rate cut, and one thing that you have to give to this MPC is that they have always been hands-on in managing the liquidity. And liquidity is a function of lot of other tools other than the rate itself, right? So we have seen that previously they have given OMOs. We have seen that, they have done on-screen buyings, or there could be VRRRs that could be introduced again. So, yes, we are entering into the festive season. We have seen that this committee has also taken a preemptive action of reducing the CRR by 1% at just in time so that there is enough liquidity that is released into the system, uh, and there's no shortage of the liquidity. If there is a further shortage of the liquidity, we will see that there might be some OMOs that might be announced at this point of time, or there could be a short-term liquidity that would be provided through it.
Sure. So now on to the questions. So first and foremost question is your view on the currency.
View on the currency. So interesting. We started the year by saying that it's all positive and the currency might not deteriorate. From year till now, we have seen that dollar index has gone down by about 4%. Rupee has depreciated by about 5%, and it is one of the worst performing currency if you see from year till date. The volatility is because, again, around the announcements and the uncertainty which is there, we have seen some rollback of it. Uh, Interestingly, it has not crossed the threshold of 89, 90 as of now. It has stayed within the range of that. And as we are seeing the positive developments coming, it should settle around somewhere 80, 87 levels, or 80, 86 to 88 is probably a range that we are looking at for the rupee based on the announcements coming in and how things panned out.
Sure. So another question is on the corporate bond fund category. What are your views on this, category as such, and anything interesting that you see that could happen in this current space wherein, the yields are in this space?
Corporate bond category is a good category to look at right now, for the reason being that in the last quarter, we saw a lot of corporate bond issuances coming in because the capital market, the rate transmission had happened. But on the banking, the rate transmission had not happened. Now, what we are looking at is that this the issuances are diminishing into the capital markets, because probably if the borrowing has to happen, that will happen from the bank side, because the transmission of the rates is happening over there. So because of that, we are at a good spot where we are seeing that the supply will reduce, and because the supply will reduce, there will be narrowing of the spreads happening in this category.
Sure. So another question is that, the debt markets also seem to be a little uncertain as the foreign funds have sold a few Indian bonds in the last few months. So how do you see, in case this happens even more, what could be the effect on the yields, particularly in the fixed income space?
So the foreign FIIs have not sold into the Indian debt
Wherein,
markets. They are actually buying in. It's the domestic who are not getting the confidence. The FIIs are continuously on the buying spree. So surprisingly, they have more confidence than us in the debt market, whereas domestic investors have more confidence in equity than in debt markets.
right. So there's another question that, says that, when will you see will you be able to see a shift in the view, as in, will we be able a view that the long-term side of the yields become a little more better at this point? And I don't think that will be happening, but yeah, what's your case on that?
Long term side of it could be function of two things. One is that if the things are going very bad globally and Fed decides for a deeper rate cuts, or gives a sign of deeper rate cut, then that gives us room to, like, accommodate more rate cut at this point of time. Second is that the supply which is there on the longer end, which has been put a request that the longer end of the curve which is there, if the supply comes down, then it becomes a function of demand and supply. And if supply is reduced, then we will see that the narrowing of the spreads happen over there. So it will depend on the global rates and on the supply side of the calendar.
Right. So another question is that, what all factors do you see in the near future which could propel forward the yields at this, in the coming 3 to 6 months time period?
Forward the yields as in,
As in, I
I don't
think
know.
what the viewer wants to ask is that, is there a possibility of another inch up in the yields, not based probably on the rate cut cycle, but, some other factors which can, elevate the yields from current levels where they are?
Um, as of now, how the factors are playing out, there seems to be a less probability of the yields inching up. But yes, we cannot guarantee that there would be no more announcements from the global side, which would impact the currency or which would impact the debt market, and the confidence might go down, and we might see that FII outflow. If FII outflows happen, then it will again lead to inch up in the yields, but no immediate factor in sight seems to be playing out for that function. We will probably see more of a range bound of the market rather than an uptick of the market, is the estimate, right?
Right. So you mean supply demand dynamics are the only ones which could, see an elevation in the yields, but also the probability is much lower over there.
Yes. Yeah,
Right.
more of the global factors playing out rather than the
Right,
domestic.
right. Sure. So another question is which sectors in the debt markets right now you see, which are looking to do better? Probably what they mean is, on the rating parts and also various issuances that we see in the debt markets, where do you see more steam at this point in time?
It depends on the risk appetite of a person. I mean, right now in the debt market, uh, we are sticking to a neutral stance, which is why we are saying that the shorter end of the curve is looking good right now. And within that, we are pretty confident across the segment that they will be doing well. Uh, your GSEC is a little range bound, and but GSEC is also a function of fast movement of the announcements that happen. So if the opportunity opens up, then we will see more movement in that market than on the shorter end of the curve. So as of now, depending on what your time horizon is, if you are a shorter term investor, then you will be on the shorter end of the curve. If you are a tactical investor, then probably you would want to play mid of the curve, and if you want to be more dynamic, then you'll play something like income plus arbitrage.
Sure. So there's another question that, since Indian bonds are included in the foreign indices now, and there's probability that allocations can increase from time to time or decrease also. Can this result in any volatility in yields at any of the time periods?
So the development over there actually is that our weight is going to come down by 1%, but to that the market has not reacted because whatever the bigger flows had to come have already come in. Now, unless and until we see that there is a very big inflow into that indices or a very big outflow into that indices, which is we are saying that a 4 to 5% of the indices has been wiped out. Other than that, an incremental flow will not play much role into the FII flows of the market.
Sure. So there's another very interesting question that, with GST 2.0 being, pushed out by the government, what are your views on the state governments raising debts, particularly, at the SDLs? Could we see more of supply over there? And, how would SDL yields sort of go on if there is more issuances that comes into the picture?
The expectation was that the SGLs would come for overissuances to compensate for the loss in the revenue that could be there. But the precise they have been since last 2 weeks raising less than what the auction amount was, says that there is some provisioning that has been done or which is not disclosed as yet, but it seems to be at a comfortable level. And actually we've seen the SDL yields coming off from there, which had reached of a previous high. So as of now, we are not seeing that the overissuance of SDL is happening in the market. And if it's not immediately happening, then we will not probably see an overissuance happening going ahead also.
Sure. So with this, Kruti, any summarizing comments that you have?
Uh, Interesting times right now for the Indian markets because we are more inward looking than outward looking. There are some things that need to be stabilized, which there are early signs on to stabilizing. So the opportunities again opening up for the debt market, and investors can keep, a eye on it. Short term and long term opportunities are there for the investors over.
Right. So thank you so much, Kruti, for taking us through this whole webinar, talking on the US markets, how the US Fed is looking at things right now to, the Indian markets and what funds could be looked at this point in time. Thank you so much. So thank you, viewers, for joining us. And we keep on talking on such interesting topics. You can connect with us on our social media handles on LinkedIn and Instagram and also Twitter. And we have also rolled out a note on this Fed decision or FOMC decision, which you can, read through our website. So yeah, thank you so much and have a really nice day, all of you.
Thank you, everyone.